let's take a look at ratio analysis. That is the word, I don't know about you, but that is the word that at one point I was very intimidated by. I wasn't sure what it meant. I am not all that great at math. Let's break it down. It's actually not that difficult, and it's very helpful for you as a business owner. Ratio analysis focuses and uses numbers that come from your accounting records. Whether you use QuickBooks or Peachtree or some other Excel or some other record-keeping system, all the numbers you need to perform an analysis of your business come right from your financial statement. And as the word ratio means, we're basically taking two numbers and we're comparing those numbers, and then we're paying attention to the trends. As I mentioned earlier, it's not the number or the value that means as much as what's the trend, what's the history, what's the direction of where the business has been and are going. The trends are certainly more important than the numbers. Helps us see what has gone on in the past and also where we are headed in the future. Ratio analysis is division. If you can divide 10 divided by 5 equals 2, because we know that 2 times 5 is 10, you've got ratio analysis. So all the anxiety I've had over the years, just let it go, because ratio analysis is division, and all the numbers you need are found from your financial statements. So what I'd like to do here is review with you some financial ratio types, and then we will wrap up the conversation zeroing in on the ratios that we get from the balance sheet, how we get them and what they mean. Liquidity is a type of financial ratio that evaluates our ability to pay back short-term obligations. A bank, any funder, investor is very interested in fact, most interested in, what is our ability to pay back our short-term debt, because anyone that loans us money or invests money in our cause and mission is looking, and rightfully so, to receive a return on that investment. Liquidity ratio is used by banks to determine whether or not to loan money. Frankly, they look at many ratio types. Liquidity is where they start, and it's typically the ratio that helps them make their final decision. The second type of financial ratio is known as a leverage ratio. When we hear leverage, we think about debt. The leverage ratio evaluates how much debt our business has, and it looks at our assets and our debts or liabilities, and it compares them. And that comparison through division helps us learn something about our business we'll look at. And then the third type of financial ratio is called an efficiency ratio. And these ratios take a look at how much a business spends in order to make a dollar. And efficiency ratios are used to judge the management of a business. So again, anyone looking to fund investing in your business is going to be very interested in the management of the business, not just the people side, but very much so the financial and the efficiency side. Your small business development advisor will also talk with you about efficiency, because there's many of us in small business that work very, very hard and very, very long days. We may not know how hard we're working for our money, but efficiency ratios help us understand that. Again, there's a YouTube video available from the Small Business Development Center out on their Facebook page that goes more into financial ratios. Any questions, thoughts, things to add to this ratio discussion? Our focus today is balance sheet, so I realize we are basically defining these, but let it be foundation for future learning. Okay, so let's focus on ratios that actually come from the balance sheet, our focus of today. The most important measurement of liquidity, and actually the most commonly run, is known as a current ratio. We do have a question here. Can you explain accumulated depreciation? May I suggest that at the end of the call, if there's time, we will touch on that and invite a small business development advisor to speak to it as well. But in sake of time and getting through the balance sheet material, if I may focus on the ratios, we'll get through that. So if that's okay, Debbie, I won't forget you, and Eric Deliri and Nick Nash will help me make sure we don't forget you. So current ratio. Current ratio is, I said, the most important measurement of liquidity. It's also the most common, very easy to calculate. We take our current assets, which remember are found on the left side of the balance sheet, and we divide that by current liabilities, and that gives us a current ratio. So two numbers in division. Both numbers we get from our balance sheet. And what this number, this ratio known as the current ratio, helps answer is the question, can you liquidate your current assets and can you cover your current liabilities? That's what a business owner is very concerned with. That's what anyone who is financing or help us to finance the business is most interested in. Can we cover our current liabilities? So let's look at a contracting business and see what that might look like using very easy round numbers for purposes of illustration. So a person named Chelsea has a contracting business, and on that balance sheet, they have $25,000 of current assets, and they have $100,000 of current liabilities. So when we do the division there, when we do the math, we end up with a current ratio of 0.25. What is that telling us? It's telling us that this business has enough current assets to pay off 25% of their current liabilities. Is this a highly leveraged or a not so leveraged figure? 0.25 tells us that this is a highly leveraged business, and it could be considered risky because the assets compared to the liabilities or debt is much smaller, and the ratio comes out to be 0.25. Excuse me. Let's take it a step further on what that's telling us. The higher the ratio, the better. So 0.25 is not considered a very high current ratio. Where we want to shoot for is 1 to 1. So we have as many assets as we have liabilities or debts, making those assets possible. Bankers like to see anywhere between a 1 and a 2. The higher, the better. So for example, if our current ratio is 4, this means that the company has 4 times more current assets than it does in current liabilities. 4 is a good number for a current ratio. Let's go back and take a look at that contracting business really quickly. So a current ratio of 0.25, using the example I just gave of 4 times the assets than the liabilities, how would we put Chelsea's contracting business of 0.25 current ratio? How would we put that into words using that example? Jump in or write it out, please. I agree with the comments. The 0.25 shows a lot of leverage. It's not so good, is it? How can we put into words similar to this example? If my ratio was 4, that means that I have 4 times the amount of current assets than I do current liabilities. The second ratio we'll look at that we can get from our balance sheet is known as the debt to equity ratio. And as the common ratio was the most important measure of liquidity, debt to equity ratio is the most important measure of leverage or debt liability. So what we do is we look back at that balance sheet again, and instead of the left side where total assets are shown, we look at the right side of that balance sheet, and we look at the total liabilities and we divide that by the total shareholders' equity. So again, as we do the math for an example, if we have $50,000 in liabilities and we have $120,000 in shareholders' equity, and we do that math, we end up with 0.42. What does that mean? For every dollar in equity, the company has 42 cents in debt. What does that mean? Again, both numbers are shown on the balance sheet. A debt to equity ratio of less than 1 is ideal because bankers consider a debt to equity ratio of 2 or more to be risky. With those reminders, what can we say about a debt to equity ratio of 0.42? Chat box or jump in. Again, a debt to equity ratio of less than 1 is ideal, and bankers consider a debt to equity of a ratio of 2 or certainly greater to be risky. And the greater the number, the more risky. So what do we have to say about that? No one ratio, for instance, the debt to equity ratio is something we're going to make decisions on, or a creditor is going to use. They're going to look at a number of ratios, but the two that we get from the balance sheet that tell us a story include the current ratio of liquidity and the debt to equity ratio of leverage. Debt doesn't include payroll, does it? Outstanding question. Let's answer that. Payroll is found on the balance sheet. Who can share what it's referred to as asset or liability, and where is it if it's on the balance sheet? Payroll liability, exactly. Depending upon when our payroll cycle is, in my business, it's once per month. But depending upon when that payroll cycle is in your business, you likely will owe your employees money before you actually write them a check. So it's an accrued liability. So in my world, if my team works for 3 weeks and the payroll time doesn't come until the end of the month, I already owe them that 3 weeks because they've already worked it. It's an accrued liability. Therefore, it shows up on the right side of the balance sheet as a liability.
For helpful places.
Thank you for watching our video. If you would like to speak with a business advisor at no cost to you, please feel free to reach out. We're the Small Business Development Center at Blue Mountain Community College. Please attend one of our workshops, either virtually or in person, or just give us a call. Thank you.